Well, good morning, everyone, and welcome to our panel about responsible investing in action. As Rami said, I'm Lenora Suki, and I manage product strategy for sustainable finance at Bloomberg. I am absolutely privileged to have three pioneering colleagues on stage with me today. Amy O'Brien, who is the global head of responsible investing at GIIN. Amit Bouri, who is the co-founder and CEO of the GIIN, the Global Impact Investing Network, and Karp, who is the founder and the CEO of Cornerstone Capital. So we're actually going to start the conversation with a polling question to make sure that we're being more responsive to what the audience is interested in. It should be on your phone on the app. The question is, what are the most important challenges in addressing demand for sustainable and responsible investing with your clients? The first answer is uncertainty about relative financial performance. Is it difficulty finding appropriate product across asset classes? Is it unease talking about SRI approaches and investments? Lack of transparency in the investment process? Or just unsure about the social and environmental impact? So as we get those results, very interesting. Okay, well, looks like at least for the moment, uncertainty about relative financial performance is in the lead there. And it looks like we've got, after that, kind of equal polling for difficulty finding appropriate product and the sort of cross-asset class challenge and use and the actual, actually not sure about what the actual impact is of these investing approaches. So, I mean, I think that, Amy, a lot of this boils down to, product and what product looks like. The space has changed so much in the last even 3 to 5 years. Conversations are becoming more sophisticated, as are products. But how are you thinking about how product has changed over time and how advisors should be addressing some of these questions that they have?
Right, so I mean, as we've been talking about the past couple of days, there has been a fundamental shift in the whole asset management industry to really embrace these concepts around responsible and sustainable finance and investing. And despite the fact that that big bar showed that there was all this uncertainty, we still have this massive growth in interest. And so I think a lot of the trends that we talked about this morning and client demand for these features in investment portfolios are what's driving us forward. And I think where we have to look at, we talked yesterday, those of you who were here, we talked a lot about mainstreaming and ESG being embedded across everything. But I think this panel is, we're going to get into more about the product dimension. I think there still really is, it's easy to say it's all going to be everywhere and we're not going to have product anymore, but I don't believe that. I believe we are still going to have an important role. I think branded products are playing an important role in driving innovation. And really, it's the client demand and the around some of the features of those products that a lot of us are focusing on now.
Right, and I mean, just drawing on the answer that was specifically focused on financial performance, I think, for those of us who are sort of, talking about these issues day in and day out and looking at the data, it's interesting to hear managers increasingly talk about bringing these factors into their investment process. And the question, the response here makes me wonder if maybe managers need to communicate better about why it's a part of their process and what the impacts are on security selection.
I mean, our whole industry has to do a lot better job of communicating the how. I mean, we heard this morning a little bit about other things like intentionality, authenticity, transparency with our first couple of panels. And I think those are types of things that we're all swirling around as an industry. I think the scrutiny on our entire industry, and particularly those products that we're holding out as being high impact or sustainable, that will help drive some of the clarity, I think, and some of the definitional clarity. But we are, to get scale, to get broader adoption, we do need to talk more about the how, and in probably a clearer and simpler way with clients.
Right. And I think actually, Erica, you are also entering into this conversation about performance on a regular basis as well, because you're talking to your clients about how to think about product and how to translate their interests, their motivations into a strategy. So how do you bridge that conversation about performance, and how do you approach it in your manager due diligence?
Well, I mean, it's easy to bridge if you make it very clear, and unequivocally so, that you do not need to give up market rate returns to have social impact or social consciousness. One thing I do need to say, and this is a little bit of a story, but you know, over a decade ago when I was asked to take on the SRI team, the Socially Responsible Investment Team, I was a director of global research, and my first response was, oh, so does that mean all other investing is irresponsible? Right, the reason I say that is because I would suggest we don't need to use the language of responsible or ethical or sustainable or impact. The reality is this is all just investing. And if we're, as advisors, Cornerstone is an investment advisor, our clients really want to know, okay, so how do I do what I care about? How do I make a difference in water, in animal welfare, in climate, in women? I want to make a difference, and I want to get market rate returns. You can unequivocally do that. What I would add on the product front is that it's actually a little bit of a dangerous time right now, because product proliferation, lots of stuff that's labeled ESG, is very different according to different people. And I would argue that there are products out there that want right now to use that term ESG or sustainability or impact or SRI, and we need to be careful. So Cornerstone spends, you know, all of our time diligencing hundreds and hundreds and hundreds of managers. So what I would say in approaching clients is just be careful, all right? Use the language of investing and really understand there is no such thing as ESG investing. There is such a thing as ESG analysis. And when you do that analysis, when you systematically integrate the right ESG factors in an investment process, then you can do whatever kind of investing you want, values-based and impact and SR, whatever you want. But this is a discipline in finance, and that's where we need to go. And then ultimately, again, it's just investing.
Yeah, actually, it's really interesting that you say that, because I think we are seeing a lot of our clients, even beyond the ESG space, just trying to use alternative lenses on understanding an industry or a company's fundamentals, and the growth of alternative data is something that is, you know, really fundamentally changing investing. So, I mean, in terms of just understanding, you know, the terms and the approaches and exclusions and divestment, and how are you thinking about that in terms of, you know, how to explain these things to clients? Because you're right, it is a little bit like a Tower of Babel at this stage. I think it's hard to piece through what it all means.
Well, we speak to our clients in the language that they want to speak in. So if we're talking to a client and you're active listening for what they care about, and you find out kind of anecdotally, they care about women, they care about climate change, they care about emerging markets, start to find anecdotes and stories that you can share. Start to find issues that get to the nexus of those things that I mentioned as an example, women and climate change. It's just a conversation. And then once you find out what they really care about, you can start to address opportunities that may be surprising to them. How does safe and affordable women's birth control have a positive effect on climate change as it serves the emerging world, right? That might not be intuitive for now, but as you go up this learning curve, it becomes really intuitive. You see the interconnected stuff, and you have these really interesting conversations with clients about what they care about. And what I can tell you, you absolutely can find product that serves to address those complexities. And that's how humanity is. It's complex. But on the other hand, it's also simple. You simply ask your clients, in nicer language than this, what do you give a damn about? And let's go find ways to invest that way.
And actually, I mean, I think that that's a great segue to Amit, because what Erica is pointing to is that people want to have often some deeper connection to their capital, and they want to understand, the impact. And impact investing, as you know yourself, is growing very rapidly. I think the last GIIN survey found about $230 billion in assets under management with impact investing mandates. It's the fastest growing subsegment of the market. On our side, I think we hear clients talking about both investing with the intent to have a social and environmental impact, as well as measuring impact in the portfolios. So I wonder if you could help sort of tease these things apart, or are they always together, or are they often separate approaches? Maybe you could help explain how that works.
Absolutely, and thank you. I think this is an incredibly exciting time to be having this conversation because there have been decades of work and people looking at how they can integrate impact in various ways into investing. But now we see this just booming all over the world. The GIIN is a nonprofit organization that's focused on unlocking the potential of investment capital to have a positive impact on the world. And our network is active on 6 continents. We have members in 43 countries. And this is a trend that is unfolding all around the world. And what I think is really important to kind of disaggregate in terms of the various components is that there are many ways in which people want to manifest their values in their investments. As you heard earlier in the day, some people are focused on getting bad things out of their portfolios, so they want to avoid harm. Others are trying to think about environmental, social, and governance factors as a way of mitigating risk. What is the risk in my portfolio and my exposure to climate change, and how would that affect my financial performance? And there increasingly are people who want to put their capital to work to have a positive impact on the issues they care about, whether it's addressing issues around diversity, helping to mitigate climate change, or helping to reduce poverty in their backyards or all over the world. Now, one of the things that you saw from the poll, understandably, is that there are a lot of questions about performance, financial performance, but also impact performance. And you would expect, and I'd hope, that investors would be asking about the performance that they can expect from any investment. One of the most exciting developments in impact investing is that we are becoming much more sophisticated about how we understand the impact of investments. And that trend will only continue. But as Erica said, this is a discipline. It requires rigor, and we have a lot of sophisticated professionals in this room and our peers all around the world who are really pushing the frontier of how we understand the impact that we can have through our investments. I think one thing that I took away from the earlier discussions that I think is so important is that the client of tomorrow expects more from their money than just making more money. So the financial services industry and advisors are, I think, catching up to what their clients are expecting in terms of products and investment opportunities. And not just one-off products, but entire portfolios that are designed to help invest in the world that their clients want to live in.
So for any client who has their money invested in one of these vehicles, they go back to their advisor and they say, okay, this is really interesting, but how do I know what kind of impact I had? How is that, you refer to it as a discipline. How is that changing? What can clients really expect in terms of just understanding what the impact of the capital is?
Well, I think this is something that's absolutely evolving, but we are getting much more sophisticated about kind of how you can connect investments made today in terms of impact that they can have, not in the current, just in the current day, but also tomorrow. And it really depends on the types of issues and themes that you're focused on. But there's been a lot of work done by the GIIN and many other organizations around the world in helping to develop metrics for measuring and understanding social and environmental performance. We operate a catalog of metrics called IRIS. It's freely available to anyone who's interested, and it includes metrics that are sector by sector. So in areas like microfinance and clean energy, sustainable forestry, and so on, that help investors connect what they're trying to accomplish with tangible metrics about business performance that contribute to those outcomes. And we are now seeing a majority of impact investors using IRIS. And we recently launched another tool called Navigating Impact, where you can start with an objective that you had, like creating affordable housing to help build more sustainable cities. and can walk you through all the way to what are the metrics that are backed by third-party research. So you can be not only ensure that you're using metrics, but ones that have been tested and proven to actually connect to the outcomes that you're seeking. That's also available through our website. These are all free services, but just some examples of the way in which tools and methodologies are being developed to answer that important question of, are my investments going to make a difference?
Yeah, and I think Erica has some experience looking at how managers are using it, probably.
So the only thing I would add is that we are still really early days in terms of measuring impact, all right? The same as our being in pretty early days about having really high quality data based on corporate disclosures. So it really is important that we avoid kind of hyperbole. So there's a lot of studies out there about the size of this market or the quality of the data or the ability to measure. And we're getting better, but the reason I say we have to avoid hyperbole is because when we use hyperbole, one, it could potentially give more optimism about how mainstream sustainable and impact investing has gotten. It's not that mainstream yet, all right? We still have time to use it, really constructively. Two, with regard to hyperbole, I worry sometimes about false precision. Somebody recently said to me that, if we can get, a million more liters of fresh water out there, we can affect this country's GDP by 0.3%. And I'm thinking, I will guarantee that that's wrong, right? So the point is, we do have to be really careful. It's early days. There are dozens and dozens of frameworks out there, and we have to decide the ones that make most sense for our clients. At Cornerstone, our clients care a lot about the extent to which they're having an impact on certain issues like gender, like climate. We personally like to talk about access. As an investor, what kind of access am I getting for people who are in need, for regions that need help, for animals? What kind of access are we offering, right? So that's a framework that we think about. And again, no false precision, just a reality, because for us to serve our clients, we have to make them feel, not just think, but feel, because that's how money moves, when you make people feel something. So we're still very early days. That's really the point I wanted to make.
I mean, I would definitely vouch for that, working at Bloomberg. The data is still very challenging to work with, but I think that it is sort of opening up conversations with clients, both our clients who are managers, who are trying to understand how to communicate this, as well as with their clients about what they care about. So I think that's a really great point about false precision. I think these are all just entry points into these conversations at this stage, definitely. I think in the time that we have, I want to hit the question that came up in the poll as well about asset classes. I mean, traditionally this space, it grew out of equities. And it's certainly growing in other asset classes, but I wonder if y'all could speak to the implementability of a strategy across asset classes for a client that is invested, across various subsegments of both equity and debt markets, public and private. So I wonder if y'all could speak to that.
I mean, I'll start with that because I think to follow up on Erica's point, it's still early days for ESG data in some public markets. So we're talking about the fixed income market, municipals, and so there's still plenty to do on the ESG side, and I think to make it rigorous and reliable and really relevant. I think we've had this proliferation of the ESG ecosystem in our world. I mean, more data should be better. It's not all good or relevant, and you really do have to get under the hood. And I think another challenge for our field over the years has been we focused a lot on ESG or sustainability ratings, and that is inherently controversial about how those methodologies are developed and applied. And so now we're putting much more emphasis on the raw data. So getting raw metrics at the company level are really important, but really across all asset classes. And the other thing is I think ESG and sustainability practices look different for different markets. I mean, for private equity, real estate, these are not metrics that you can easily sort of add together and show a client. So that's why I think we have to focus more on outcomes, themes, I think, to bring it all together for clients. That's something else we've been thinking about at Nuveen.
Yeah, right. And I mean, I think in different asset classes also, like the investor or the portfolio manager is also interacting differently with the company. They have a different voice, different capacity to sort of engage
And I think
companies
connecting
as well.
the dots and the partnerships, between the investors, companies, both public and private companies, intermediaries, I think we've probably just been a little bit too siloed in our field and not really creating those points of connectivity. But I think we'll see new types of partnerships and those kind of collaborations helping to accelerate, scale going forward.
Yeah.
A couple things I just want to touch on. I think this point about kind of the state of practice around impact measurement evolving is absolutely critical to highlight. But I do think it's a really exciting time to think about just how much kind of like intellectual horsepower is going into this question of how can we be better about achieving a positive impact. And if you think about the decades and decades of work around financial performance measurement, and of course now we just take it for granted about how we think about financial performance. We are in much earlier days when it comes to impact performance, but it is a time where we get everyone from people who are development economists to people who are large mainstream institutions trying to crack this question. So I think even the past couple of years, there's been a lot of evolution, and if you draw that trend line out, it's incredibly exciting to think about all the sophisticated kind of intellects going into these questions about how can we use investment capital to both meet kind of client interests as well as achieve a positive impact in the world. I also think this point around asset classes is really critical. One of the things that we've observed in our network over the past couple of years is that many investors who started with a strategy in one specific asset class are now broadening. And I think that's part of why we're a network, is so people can share ideas and be exposed to new approaches of doing things. But we are now seeing a transition from kind of point strategies in specific asset classes to portfolios. Ranging from everything from cash management strategies all the way through to illiquid kind of private investments. And I think that's really opening people's minds to the possibility that they could have around achieving impact through every component of their portfolio, which may look different with different strategies, of course, but I think that is also unlocking a ton of potential for this world.
Yeah, I think that's a really great point about implementing for impact across asset classes as well. And I'm sure, Erica, you must be seeing your own.
Well, this is precisely what we try to do when we consult with other RIAs and think about what our clients want. It usually is a pretty typical asset allocation story, right? And so since we're talking about ESG integration, ESG analysis, it's knowing which questions to ask on what asset class, depending on how it behaves, and which question to ask on what sector we're talking about. And those are the questions that are material to the economic outcomes. You also have to remember that across an asset allocation, there's also differences between what clients are willing to take or not. Most of our clients look for market rate returns, but we do have clients that are comfortable with some concessionary returns, in particular, with their venture money or their PE money. So it really is very bespoke, depending on what the client wants. But again, you can find appropriate product across asset classes.
And I think one of the questions that's often raised about impact across asset classes also is this idea of engagement and engaging with companies and having a direct impact on the companies through networks, through direct conversations with the companies. I mean, that to me seems like it's another really important and often kind of underlooked element of impact.
I would argue that is central to sustainable investing. Active ownership, feeling like a steward of capital, that dialogue with the company in a constructive way is critically important. And everyone can be involved in active ownership. It goes back to what I said about knowing the questions to ask. That's a good start. And so, when it comes to managers and the situation with, passive versus active, to some degree, sustainable and impact investing is by definition active management. So that active ownership conversation is a long one. We can
it's a critical way. I think it's a critical way of looking at managers and how they engage in the market.
It's not just about public equity anymore. I think that's it's a principle across all asset classes. So I think for large and small managers alike, I mean, clients are looking for you to use your influence with companies. And so that's a tool. I mean, we typically think of it as the proxy voting, and it's critical. It's critical to engage at that level. That's sort of where engagement started. But now we're seeing opportunities to engage really across all asset classes, in our case, and with the tenant farmers and the occupants in our buildings and the real estate, the GP-LP relationship. And so I think that's another principle that's being built out in a really meaningful way across asset classes.
Yeah, I think it's absolutely worth sort of pursuing in conversations with managers and when you're thinking about product. So actually, we're out of time. So I want to thank my colleagues, Amy O'Brien, Amit Bouri, and Erica Karp. Actually, they're going to stay on stage for an Ask the Experts, and I am going to leave the stage. But thank you very much. Thank you to all of you.